that we believe will benefit you and your customers. This is News You Can Use.
Hey, welcome everybody. I hope that our communication today finds you in good health. Make sure your hands are clean. Do not touch your face. Don't touch your face. Anyway, prayers out to everybody that knows somebody at this point that has been impacted so far, either with a job loss or otherwise is sick. And probably by the end of this, we'll know one of each or maybe more of that. I want to start by going backward. In about the last 45 or 60 days, we had two guests that we normally have on our program show up. And at the time, of course, none of us really understood the impact that coronavirus was going to have. But I asked the question to Doug Duncan, the chief economist with Fannie Mae, in late January when I interviewed him for our February Personal and Professional Best program, if the coronavirus could be a black swan. And a black swan is basically an event that can't be anticipated, that takes place, that disrupts. So we asked the question, of course, innocently enough, but I just thought it was a reasonable question to ask. Doug's comment was no one could really tell at that point, but he didn't think so. By the way, Doug is one of the top economists in the world, and he specifically is an expert in the housing industry. At the time he left us with this information on housing, this is to start the year, with historically low unemployment rates, historically low interest rates. At the time, he was anticipating housing this year being up 2.3%. He was not anticipating the Federal Reserve to make any rate cuts for the year. He saw interest rates as flat, and they were, that is the Federal Reserve, their short-term funding rate, 30-day funding rate at the time was 1.75%. So we're talking about, this is about 45 days ago. The second person that I talked to was David Rodriguez. David is my personal doctor. He's well credentialed. And I asked him the question with regard to coronavirus as well. And at the time, in fairness, not only to David, but to really every doctor, every person, everybody had a different kind of perspective. And this was in February when I talked to David, in the middle of February, and it was just getting started here. And David thought it was going to be a bad flu. Another strain of flu that we had not seen in some time. So I was a bit personally incredulous with the whole topic of coronavirus, probably like a lot of you, until about 3 or 4 weeks ago when it began to snowball. And what we have seen since has been a substantial snowball, one like most of us have never seen. And it's got consequences now like we've never experienced as Americans, having to stay at home, being quarantined. Being told what to do, where we can go, seeing bars and restaurants, and so many different things take place in such a short period of time. So today, what I'm hoping to do is just to bring all of you up to speed, particularly in our industry, as to what is and what isn't, because there's an awful lot of rumor and innuendo, and that's typical when you have a dynamic and unfolding event like coronavirus. I want to tell you, first of all, at 58 years old, that I don't think this is, and I had the question asked of me earlier today, is this the financial crisis, like the financial crisis? The answer is, it is a financial crisis, but it is not like the financial crisis, the Great Recession of 2008. It's not. It's more akin to me to 9/11. 9/11 was an unexpected event, a black swan, that radically changed the way all of us felt. Fear, insecurity is what we felt, because our borders had been breached. Planes crashed not only to the World Trade Center and created a horrific event for all of us to live through, but also into the Pentagon. And there were many other threats that were in the aftermath that put us in a very uncomfortable position. And in fact, in a similar way, travel, conventions, many things shut down. The economy basically took a bit of a nosedive at that point. And then people got back to work and things got back to normal. It feels more like that than it does the financial crisis. By the way, the financial crisis happened when the heart of our economy, banks, were sick. They were very sick. Banks are not sick today. So to the extent that we can recover, I like to think about this more like 9/11 than I do the financial crisis, which of course took many, many years to recovery. So what's true for all of us is that we're all currently experiencing at this point what's natural, which is fear. What does this mean? What does it mean to my health? What does it mean to my job? More importantly, in a lot of people's minds, what does it mean to my job and to our future, my family, our significant others? What does it all mean? And by the way, I'll tell you that Thursday at 4 o'clock, we're hosting with Dr. Andy Ward. We're going to host a personal professional best program. It'll be kind of like a cocktail hour, hopefully a happy hour. But Dr. Ward will be talking for 15 minutes about how to best respond to those feelings of fear, of anxiety, of worry, which are, of course, natural. What I found is that the best response, past what Dr. Ward will share with you on Thursday, is to operate out of faith, somehow, some way, believing, doing all the right things, quarantining, cleaning the hands, don't touch the face, doing all those things, but then also believing that somehow, some way, that we're going to make it out of this whole thing. So let's kick into gear. Here's what I want to talk a little bit about: the macroeconomic circumstance, kind of what's happening and kind of how that is being dealt with, if you will. And then second, what's really happening in the world of housing finance, specifically the consequences that are going on in the big picture economy, and then how does that affect what's happening in our business every single day. First thing I'll tell you is thank God we were made to be one of the essentials, right? Because we still have a chance to continue to do business, whatever business is out there. And by the way, I'll tell you, it's very interesting and strange to be in my office here in Alpharetta, where there's normally some 75 to 100 people every day, and to have maybe 4 or 5 people here. But we're also today closing out a record number of mortgages for the month of March. So business was and continues to be, interestingly enough, very strong, and we'll hope it continues at least until we can see the coronavirus impact kind of change. Short-term macroeconomy, let's talk about what's happened. First of all of you are well familiar, the travel industry, hotels, bars, restaurants, cruise ships, casinos, the NBA, the Masters, the Olympics, all of these things already have been changed. People have gone home without jobs in a number of different industries. In fact, such that last week, the weekly unemployment number, those who filed, newly filed unemployment on Thursday, was 3 million. The biggest ever was about 650,000 in a week during the financial crisis. We had over 3 million last week. So, of course, that's to be expected because of the draconian nature of what we had to do and have had to do in terms of quarantining, sending everybody home. So a lot of people are just simply out of work overnight. I've never seen anything like that. Very simply, I want you to understand something. GDP, the gross domestic product, that is the way to measure our economy. That is how it's measured by economists in the highest level, right? 4 trillion roughly right a year is the revenue. Products sold, services performed, about 4 trillion a year. We are estimating right now that about 40% to 50% of the economy is basically shut down. So an annualized economy of 4 trillion, 40% to 50%, about 2 trillion has been shut down. So that's kind of a big deal. Goldman Sachs, one of the top investment bankers on Wall Street, they're one of the first companies now out with an estimate about what this means, macroeconomy short term, and they're seeing a 15% jobless rate. To put that into context, we are currently at 3.5 to 3.6% unemployed. They're talking about in the next 60 days it going up to as high as 15%. And they're talking about a GDP of, get this, minus 34% in the second quarter. Well, that makes sense, right? Roughly 40% of the economy is shut down, so we're just going to do less business. Of course, the toilet paper industry is on fire right now, right? It's screaming. It's doing really well. So anyway, just context, that's what is really happening. And now, what's the response to that from a economic standpoint? Well, there's 2 responses. There's the Federal Reserve, which is monetary policy. They're in charge of monetary policy. They have 2 mandates: full employment, and they have a mandate of keeping inflation at 2% to keep the economy going. If you put that slide back up just for a second, here's the deal. What the Fed has done already, it's amazing. They did an emergency rate cut on March 3rd, which was a half a point. So they started the year, Doug Duncan guesstimated no cuts. They did their first one March 3rd, and then they did another one March 16th. They're down to 0 now on interest rates. I'd say that's pretty low. So a lot of your consumers out in the marketplace think that our rates are 0. They're not, but that's what's taken place. The Fed has also supported and is committing to support almost every industry right now with liquidity. They have announced, which when I read this, I was like, thank God. And then I was like, oh my God, thank God that they're doing this. And oh my God, that they're having to do it. That is, they're buying treasury debt from the government themselves. They're buying mortgage debt. They're buying municipal bonds. They're basically investing in a lot of businesses to calm down liquidity. So monetary policy is up and fired up and running. All of you are quite familiar now with the economic event and the response to it as well by Washington. That's called fiscal policy. And what we've seen now is that we finally did get a bill passed. It was at the 4-yard line, 2-yard line, 2-inch yard line, 1-inch yard line, and we finally got it done. It's a $2 trillion stimulus. So go back to what I was talking about, the macroeconomy. A $4 trillion economy, about 40% of it shut down, and what the fiscal policy folks in Washington now has done, the Senate, the House, and the White House all agreed on a $2 trillion support plan to go to the economy to backstop it. So that's what's up. March will be the first month in 130 months that we see anything other than positive growth. We've had the longest expansion in the history of the United States, 130. What's next? The next 60 and 90 days, we're going to see some of the, let's say, least pretty numbers in the economy we have ever seen in terms of unemployment, in terms of retail sales, car sales. There's just going to be an awful lot of disruption. And what we're all hoping, the road to recovery is going to be a really deep decline for a very short period of time, 30 to 60 days, followed by a really steep growth. And that's what we're all hoping for. Let me share with you now a little bit more detail about our industry, right? So the Federal Reserve, they don't set our rates, but they do set kind of a rate called the Fed funds rate, which kind of affects all of the other rates in the economy. They also have agreed to buy mortgages. As a buyer, that means that they'll put more pressure on the market, 30-year fixed rate mortgages, and attempt to bring rates down. So again, the Fed went from 1 3/4 on their funds rate, overnight 30-day rates, to 1 1/4 to 0. Year to date, we've not really seen, from the beginning of the year to today, a material change in 30-year fixed rate mortgages. If you stare at the blue line, that's the 30-year fixed rate starting the beginning of this year. We've seen little change. We've had kind of a flat. We started out, we went down, we got a big refinance surge, and then we've gone back up. The Fed's hope is that they will be able to get interest rates to go down, 30-year fixed rate mortgages. By the way, that'll be really good for 2 reasons. One, it'll be really good because it will take $11 trillion of mortgage debt, which is the national amount of debt that is out there in the mortgage industry, and a lot of it will get to refinance. And if it gets to refinance, it's kind of like another stimulus because people will start saving $200, $300, $400 a month, which is an awful lot of money to put back in the economy without Washington having to pass any bills. So the Fed knows that and wants to create that as a stimulus. The second benefit is, to the extent that rates do go down on 30-year fixed rate mortgages, that'll put us in a position where your buyers, the ones that are still out there, are going to get even a better deal. And when the recovery hopefully turns, whether it's in May or in June, we'll have the lowest rates ever in history, and that'll be helpful to get the economy out of its ditch. Now, those are the 2 positive things. Refinances and home buyers would be really happy with the lowest rates in history. The other downside of that is it's created some dysfunction in our business in terms of servicing values. And I want to make sure that you hear this because that's creating problems now in the mortgage market. You've been hearing about this. You probably have heard that FICO scores, minimum FICO scores have gone up. You probably have heard a company called Angel Oak who made non-QM bank statement kind of loans from a long time ago. Those have been automatically moved out. You've probably heard that bond loans are up in the air as to whether or not the Chinoas and other bonds are going to be available. You've probably heard that some jumbo products have been reduced. All of those things are true, and they tie back to a fundamental principle called loan servicing. So what happens is this: when someone gets a mortgage, there's two components to it. The one component is the payment, which is an interest rate payment. That goes on to the bond investor. Guess who sends it on to the bond investor? That's right, the servicer. So whoever you service it with, you send the payment to the servicer. They take some money, they get to profit some, and then they pass on the balance to the bond community who bought the mortgages. That's all fine and good, but now what's happening is the value of the servicing is being considered to be zero. And why is that? Because rates are going down. Servicers thought the loans they did last year would stay on their books for 5 or 6 years. That's the value that they ascribed to those assets. Well, the Federal Reserve, trying to get mortgage rates down, is helping to consider customers a refinance. So that's one reason values are going down. The second one is really interesting, and this is a part of the crisis. That is, there's a thing called forbearance. So if there's a loan out there today, and we've made loans, of course, and they lose their jobs to coronavirus impact, there is, in many cases, a theory and then a reality that the government will tell us in the mortgage business that it's okay. They can take off 3 to 6 months and not make their mortgage payment. The problem is the servicers still have to make the payments on behalf of the customers. So let me say that again. Normally, customers pay us, the servicers. The servicer pays forward those dollars to the investors who bought the mortgages. If the customer doesn't pay us, we still have to pay that. Now, we get reimbursed as an industry, servicers, by Fannie Mae, Freddie Mac, and Ginnie Mae ultimately, but it takes some time to get reimbursed. And in the interim, servicers today are looking at a huge run in forbearance waivers so that customers don't have to pay during coronavirus, and that would create a tremendous liquidity problem. So that's what's driving servicers not to want high-risk loans right now. And high-risk loans are low FICO score loans, low down payment loans, loans where we don't document income, which is very small, and jumbo loans to some extent. So what I want you to know is that to date, there's been a lot of talk in the last couple of weeks in our industry, but what's really happened is FICO scores have come up from, let's say, 620 to 640 in some cases. We're talking about less than 5% of all the homeowners, by the way, who get mortgages having FICO scores less than 640. So it's not that big of a deal. Jumbo, very similar. About 3% to 4% of all the units in America are financed with jumbo. Bonds, a very small number. So far, this servicing problem has brought some changes to the mortgage industry, but it's not at the point now where I see it as a real problem short term, unless they don't fix the problem. My guess is the Federal Reserve and the Treasury will fix the problem in the servicing industry so that if the customers don't pay, the servicers don't have to, and that would in large part slow down the train that started in the last couple of weeks in our business. So that's really what's up in the servicing business, and there has been some movement so far. There has been some movement. The biggest problem today that you as a realtor need to think about in terms of the mortgage business isn't really all the credit changes so far. They could be a problem. We'll update you coming up here again soon with regard to what's next in terms of the servicing issue and credit change issue. The biggest issue as of right now, today, this moment, is that the large banks are inundated with refinances. A lot of the credit unions, Navy Federal Credit Union, if you go to their website today, they'll tell you they can't close the refinance for 6 months. The same thing from Bank of America, Wells Fargo, many of the other big banks. I'm not saying any of them are bad companies. That's up to you to decide. The reality of it is I think they're all fine companies. They're just not very good at purchase business. And if you have a purchase transaction today that needs to get done, you need to, more than ever before, give your customers advice about where not to go. And I'm just telling you, the system is inundated with refinances already. And if rates go lower, that'll be good so people can refinance. But it will be further inundated. And there's some companies that are just not able to respond. Keep in mind one other thing. Up until a couple of weeks ago, we were all full-time on staff at the companies that we work for. Bank of America, Wells Fargo, Supreme. Everyone now is working virtually. Some are better at working virtually than others. That's just a reality. So be very, very, very mindful now if you have a transaction about where you actually want that transaction to go, because it would be very important. Again, just a real quick summary. Here's what we've had happen so far in the credit side. The non-QM, non-qualified mortgages, like old school kind of subprime, bank statement loans, no doc loans, those are kind of out. Short term, that's out. And that's not going to come back anytime soon, in my opinion. Some jumbo products have been shrunk down a bit at this point. Mostly, you're still available, but let's just say credit underwriting is a little tighter today, and it's going to get a bit tighter. And if anything, loan to values have gone down a bit there. So it's still available. Jumbo money's still available. But on the margin, maybe only 90% of the people who could have gotten a loan are going to be able to get through at this stage, right? So it's still okay, but it's not as good as it was just a couple of weeks ago. And there's been FICO score increases across the board, affecting the weakest credit customers, and we do those loans too, and also bond loans. So you just check in with your loan officers and see what's up with that. But at this point, there's not a material disruption, thank God. One of the things that Doug Duncan and I talked about at the beginning of the year is that, so we had lowest rates ever, we had lowest unemployment ever, housing was in great shape. We had one problem. We had too many buyers, never too many buyers, but we had a lot of buyers and not enough sellers. Well, if we have fewer buyers here in the next 30 to 60 days, we still may be making deals. That's why we still are. We had a great day yesterday in applications for purchases. So the market's still got people that have jobs, that want to buy, can get under contract now, particularly in the under 500 price range. So anyway, the industry's made a lot of accommodations already for appraisals, things along those lines. So you should know that Fannie Mae, Freddie Mac, Ginnie Mae, they're all at work trying to make this work with everyone pretty much being virtual, and we're still an essential business. So all that's good. By the way, I want to speak to Ron, not Ron Burgundy, but Ron, the remote online notary. Obviously, we're all getting innovative about how to do business now differently using Zoom. We're Zooming all over the place, right? The reality of it is we're going to find ourselves in that pattern of behavior, different, and we're going to find innovative ways to do things that we'll probably keep. They'll be more productive in the aftermath of this event. And all that's good. That's what we do here in America. We find ways to innovate, particularly when you have to, which is like right now. But the remote online notary is something that everybody wants to see take place. There's a lot of problems between here and actually doing it. We're on board with supporting it as long as the investment community, Fannie Mae, Freddie Mac, Ginnie Mae, the federal government, and the local governments are all in support. So there's a big orchestra of people who have to all want in. It's not just the local government saying we'll do them or the attorney saying we can do them. There's a whole lot of other people in the orchestra that need to be able to do it. Let's talk a little bit about Supreme Southeast if we could. I just want to give you an update so you know where we are at this moment, so that you know we are open to do business, and we are. Today we'll close around 70 transactions, and so we'll finish this month. It'll be a record month for our organization, and we really went seamless. I say to people two things. You have to have will, and you have to have skill. And will is the willingness to do whatever it takes to deliver the industry's best customer experience. That's what we have. That's what our culture is. It's the will to do it, and we've got it. I don't care if we're working here physically or whether we're at home virtually. Our folks are killing it right now to make sure that you and your customers get closed on time, funded on time, and that you get paid on time. Can you give me an amen to getting paid on time? Amen, right? Everybody wants to get paid on time. So we're functioning right now with the same metrics we always have: speed and close on time and fund on time, and high satisfaction rates for our customers when we complete the exercise. We are still open in the month of April. We're just going to get there tomorrow. But we can still do purchase transactions in 8 days, 9 days, 10 days. So help me help you, right? So if you'll support Supreme Southeast right now. And by the way, all of you, if you're joining, are probably in our partnerships throughout the Southeast. This is the time. It's like we're going to support Thursday night local businesses that are all friends of yours. We're friends of yours in your offices, whether or not you've been doing business with us or not. This is the time, because we're continuing to financially support and contribute to your concern business out there. And we are grateful to have the opportunity to be in partnership with all of you. But we need back now that reciprocity, if you will, that support back. So all the agents that are out there, if you do business with us, great, thank you. If you're not, this is a great time to give us an opportunity. Again, 8-day closings, purchases, 9-day, 10-day, we're in. We limit 8 days because the government won't let us close them any faster, but this past month we did just under 200 transactions in less than 10 days. So we can rock and roll and go, and we're still open to do that. At this point, there aren't no impediments, major impediments for us to do that. SRS, Supreme Rescue Service, if you're not aware of it, get aware of it. If there's a loan stuck someplace and you need help, call our loan officers, the ones that are in your account. They'll get an opportunity to look, and then we'll move on. I want to go through really quickly with you, and then we'll open up some questions. The road to recovery, just so you know, I told a group of folks the other day that I had an opportunity to speak to that imagine it's July 1st right now, right? Imagine it's July 1st, and we're out actually shopping, and we're getting hamburgers, and we're going to have like a big, great time July 4th weekend with family, and we hopefully won't be having to spend a lot of time, far away from each other. Imagine we're going to get there. Now come back to today, which is March 31st. We got some tough sledding in front of us. We do, to get from here to there. So here's what the road to recovery. It's 3 things. It's monetary policy, the Federal Reserve. They have done anything, everything. They will continue to do it. They're kicking it right now. Amen. Thank you. The second thing is we need Congress and fiscal policy. They finally got a deal done. Beautiful. $2 trillion. The 2 was a big deal. They'll do another one if they have to. It just depends on how long this event lasts. But that was a big deal. So those 2 fundamentals had to be in place for the recovery to actually take place. And keep in mind, we don't have all of the consequences of the downturn yet fully assessed. So there may be some adjustments, and will be some adjustments by the Federal Reserve and by Congress to deal with this event, the impact of coronavirus. But those 2 players are in the game and playing right now, and playing serious. So we're good there. The third thing that needs to happen, and this is something I'm praying about, I hope you will too, is we simply need some good news on coronavirus. We need it to flatten out. We need a vaccine. We need different testing. We need somebody to come up with an antiviral. We need the weather to change and it to be one of those flus that can be affected, impacted. We need a combination of all of them. We need something good to happen, because that will start the process of us thinking about getting America back open for business again. That is the road to recovery. It is monetary policy, it is fiscal policy, and is getting some kind of benefit with regard to the event itself called coronavirus. Let me go through a question or two. What if a buyer is pre-approved for a specific amount, an offer was accepted, and then they had to pull out yesterday, 24 hours later, because of credit score not being available? They should be able to do that, earnest money-wise, if they're not going to be able to be approved. We have a responsibility to do one of 3 things when someone files. This is a federal responsibility. When someone files an application with Supreme Lending, it's the same across the country. we have one of three things that we have to do within 30 days. We have to approve the customer, we have to decline the customer, or the customer has to withdraw. In this particular case, they would probably be able to be declined because they would not be eligible for a credit score. What you should do is make sure that the loan officer, whoever you're doing business with, has gotten access to the best credit talent, because there's oftentimes things that can happen to move credit scores higher. We just hired one of the most talented people in America from Credit Technologies, one of the biggest credit companies in America, who's on staff now, Lisa Meyer. She's done credit seminars for all of you in the past. Lisa's there for our loan officers. So if we have a credit score, let's say of 618, oftentimes we can give customers instructions about how to improve their credit scores. So good question. That's what's up. There's a lot of chatter about forbearance programs rolling in soon. Can you give us any information on what you see these programs looking like? The answer to that question is we really don't know. There's been a lot of conversation that they would be 6 months, add the payments on the back of the mortgage kind of thing. That will probably take another week or two to get settled, because you have Fannie Mae, Freddie Mac, who really own the loans. And then you have Ginnie Mae, which is a issuer of securitizations for FHA loans and for VA loans. So you have Fannie Mae and Freddie Mac securitizations. You have Ginnie Mae, which covers FHA and VA. And those authorities have to be the ones to instruct the servicers as to what they will and what they won't do. And then the servicers just play it out. Now, the servicers have some latitude in this, but I think it's going to start there. And I do think probably within the next 2 weeks, we will get some settlement there. What is the best option for non-traditional jumbo loans if Angel Oak is not around? Seller financing. In the short term, there's two types of loans. There's QM, qualified mortgages, Fannie Mae, Freddie Mac, FHA, VA. There's non-QM, which includes bank statement loans like Angel Oak used to do, jumbo loans. They're all non-QM. Those loans, the jumbo loans that are really high quality credit, banks are going to continue to want to do those. We do those as well, so we're cool there. If there's margin on the credit, there's some issues, or in the case of the bank statement loans, the only way to get those done is seller financing right now, or because I don't see anything showing up anytime soon. We'll see. They may come back in 2 weeks if we get some answers to some other questions. So stay tuned. We'll keep you up to speed. Even though we don't sell those loans, if we wind up getting information about what's happening with them, we will make sure we get a news you can use out to all of you. How is underwriting handling industry layoffs with the borrowers believing they will be rehired, i.e. teachers and other essential workers? Bottom line is at the time we make a loan, there is a law called Ability to Repay, ATR. We have to be able to qualify the customer can pay the mortgage at the time we make the loan. So we check 5 days, 3 days before a loan closes to make sure everybody's still employed. If somebody was to lose their employment at the closing table, we actually wouldn't fund the transaction. It's not supreme. It's the way the industry is designed to operate. So the answer is, of course, we want to be as supportive as possible to our customers and underwriting them in any way we possibly can. But at the same time, they have to be able to repay, because we can't make a loan in America unless they have proved to us that they can repay, and that obviously has a lot to do with cash flows. Another question, are there any products available for the low credit folks? What I tell you is that I would expect that may, because listen, FHA doesn't put credit floors in. The industry puts credit floors in. The reason the credit floor went in at 640 for most lenders is because, and we're not there, but the reason that number just kind of kicked up, some have gone up to 680, has nothing to do with FHA changing their guidelines. FHA will still buy loans with less than 640 credit scores. The issue is the servicers thinking they're going to make a loan to a customer who's relatively weak, cannot repay it, in which case now they're in a position where they have to provide the forbearance payments on behalf of the customer, and then we have a problem. So that is, the servicer has a problem. So if the servicing problem gets resolved, which I expect it will in the next 2 weeks, and we will notify you on that topic, then it probably takes the pressure off of some of the issues with at least FICO scores having gone up recently. What is the turnaround time for VA loans? So we do VA loans regularly in less than 30 days. We have not gotten any report at this point that we cannot continue to do them. The only thing we're really dependent upon, third party, is the appraiser. And since that appraiser, different than FHA loans and Fannie Mae and Freddie Mac loans, we don't control that process. They actually work for the VA. That process is kind of a separate and aside, but we've been getting them done regularly in 2 to 3 weeks. We don't expect that's going to be a problem. And again, if you leave with one message today, the Federal Reserve and monetary policy has done yeoman work. Congress, however they got there, they got there. They've stepped to the table. So those two things are there to bolster the economy as it goes through a very difficult time and to help it recover in a hurry when we get to the other side. So that's a big deal. The second thing I want you to leave with today, absolutely positively, is we've had on the margin some things change in lending, but not enough to materially impact housing, okay? Not. The biggest thing you need to know, though, if you put somebody on contract in process to get a mortgage today, make sure they go to the right company that's not so inundated with refinances that they cannot get you to the finish line, because this would be a terrible time not to make every transaction count. Every transaction always counts, but now, particularly, as you know and I know, every single transaction matters. And we're open for business here at Supreme Southeast to be able to do your business. We are going to check out for the day. Thank you all for your participation today. 4 o'clock on Thursday, we're going to do a personal professional best with my good friend, Dr. Andy Ward. He's going to be talking to you about how to manage fear and stress and anxiety and worry, and how to talk to your kids as well about dealing with this event, because, well, they need to know and you need to be able to give them some advice. So we invited Dr. Ward in. He's given us great advice that you can take, and hopefully it'll benefit you, and it'll also benefit your children and your family members as well. And please invite them. They're welcome to participate in our Personal Professional Best program, which again is going to be Thursday at 4. It's going to be kind of a cocktail hour, so hopefully we'll have a little fun together. And we're also going to make the world a better place. We're going to give away thousands of dollars. We'll play trivia like we always do. Supreme Man will be showing up with a glass of wine. But we are going to play trivia, and we're going to take the winners, and we're going to give dollars to the winners to give to businesses that are in their local communities that desperately need our help right now. So that's what's happening in the economy and in housing and here at Supreme. And we will see you Thursday at 4 o'clock. God bless all of you.
Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.